Okay. So the next question is Foster's IRR would be what they are asking. I think the data is here. So can you find out the
Your screen
IRR?
is not visible, sir.
Once again, I'm sure. Can you see now?
Yes, sir.
Okay. So the question is Foster Manufacturing is analyzing a capital investment project that is forecasted to produce the following cash flows and net income. You have the cash flows and net income. They're asking Foster's internal rate of return. So can you calculate this? 40-second question I'm giving.
Yes, sir.
Start. So what are you going to do? You are going to take the cash flows, right? That
Yeah.
is what we always do. So after
Mm.
tax cash flows will take. So after tax cash flows are 20,000. Then this is at the 0th period, and
Mm.
then year 1 we have 6,000. Year 2 we have 6,000. Year 3 we have 8,000. Year 4 we have 8,000. Right? And then the discount factors we are going to take. We are going to take the discount factors. The discount factors, like at the rate of 12%, the cost of capital is 12%, right?
Yes.
At the rate of 12%, the discount factor, like the first one, it is going to be 1.00. Okay, this is the present value we're going to find. And then here, uh, 0.893, it is at the rate of 12%. How I got this? I'll just tell the first one, 1 by 1.12 whole power 1.
One. Okay. Okay.
And the second one 0.797, and then 0.712, and then 0.636. You multiply these two, you'll get the present values. So first one is going to be 20,000 as usual. This one is going to be 5358. Second is going
Four.
to be 4782. Calculate.
4782.
Yeah, 5696, and then 5088. So 924 is your NPV, right?
Yeah.
So, what are they asking? The internal rate of return. So, see the answer here at 12%, we are getting a positive NPV, right?
Yes.
See, so if you want to accept the project, so we can go for a trial and error method. What we can do? We can take trial and we can do trial and error method, right? See, for
Yes.
this you are getting a positive NPV. Okay, the another one you should get a negative NPV. Okay, and between these two rates your IRR will apply. Will be be existing. Trial and error method, right? I've sent some videos to you for that forecasting project appraisal I've sent, right? Hello.
Yes, sir. Yes.
In that, the last question was like based upon the trial and error method, right?
Yeah.
They are asking Foster's IRR is like rounded to nearest whole percentage. If I take 12%, I got a positive NPV. This can't be. Okay.
Yes.
This is
Yeah.
not at all a percentage, right?
Yes.
Right. So what is the meaning of IRR? IRR is nothing but that rate at which your NPV is
NPV
zero.
is 0.
So with 12%, I'm getting positive NPV of 924. It's not zero. 5 is
Hmm.
not a percentage. We will try with 14%. If 12% is giving me positive NPV, 40% will definitely give me a negative NPV.
Negative.
But I don't want negative NPV. I want zero, right? So let's
Yeah.
try with 14%. I'm putting the same things here. I will give you the discount factors here. You just try
Oh,
to multiply. Yeah, 14 at the rate of 14%, the discount factors.
okay.
Yeah, first one will be 1.00. That's understood fact. 3 digits. 0.877 first year. 0.769 second year, 0.675 third year, 0.592 fourth year. Okay, just multiply
Okay.
this and subtract 20,000 with that and tell me what is the answer you are getting. So 20,000
Okay.
into 1 will be 20,000 as usual. 6,000 into 0.877, this I'll keep it negative, will be how much? 5,262, right?
Yeah.
1,614, the third for the for the
50.
second year.
Mm.
For the third year, 5,400. For the fourth year, it will be 4,736. If you do, you'll get 12, which is almost negligible value, right? Zero, almost near to zero, correct?
Yeah.
So your IRR would be at 14%. Done.
Okay.
Please make a note of this. We'll move forward.
Yes. Done, sir.
Yeah. Next question. A firm with 18% desired rate of return is considering the following projects. On Jan 1st, year 1. Jan 1st, year 1, the cash outflow is given to you. Project A, there is an investment of this much. Project B, the investment is this much. That is outflow. And the inflows are this much, right? At the end of the year, right? For both the
Yeah.
projects. And the IRR is this. For this, the IRR is what is not given. So the present value of $1 due at the end of n periods, fourth year, fifth year, sixth year. That means periods like fourth period, fifth period, sixth period.
Mm.
They have given the like yeah. So it's like from year 4 to year 5, right? So they
Yes.
have given all the present. They have given the factors. They're asking
Mm.
you using the NPV method. Projects A NPV is what? So I think you can solve this, right?
Yes, sir.
Please try this. I'm waiting.
Okay. Here, IRR, we have to take 16%, no, sir, or 18% for project A.
They're asking NPV, not IRR. So your cost of capital is 18%, right? That only you should be
Mm.
taking.
Okay.
IRR has nothing to do in case of NPV calculation.
Okay.
Only the cost of capital.
Mm.
Just a second. Samrin, continue.
Okay.
See, the question clearly says firm with an 18% desired rate of return is considering the following projects.
Mm.
There are two projects, right?
Yes.
And they are only asking about the project A's NPV. And the cash outflow is given inflow. They have given year 5 here, right?
Yes.
So once the outflow is done, like on Jan 1st, let's say that is the 0th period. So December, like first year end, this is the 0th period. December 31st, first year, right? 1 year. Then 2 years. Then 3 years. Okay. 4 years. 5 years. December 31st is the 5th year, right? So after 5 years, you are getting the inflow, right?
Yes, sir. 7.
Right. So
Yeah.
that's the reason why we will be considering the factors here at the rate of this 18%. So what are the so the discount factor is 18%. That's understood fact. So 0.4371 will be the factor for the 5th year, right?
Yes. Into 7,400.
Yeah. So now inflow is 7,400. So 7,400 into, so NPV is present value of inflow minus outflow. 7,400 into 0.4371 minus 3,500. Can you do this?
Yes. 3,234.54 I am getting. Minus 35,000 is negative NPV I am getting, sir.
Yeah, that will be how much?
2,65,460.
Done. Okay, this is the answer. Okay, shall we move
Okay.
forward? So if someone
Yes.
wants to do, they can put 3 zeros here, 3 zeros here, and can do it.
Mm.
Next question. Next question, they are asking the expected NPV. Okay, so you can read this entire question.
Okay.
Since they are asking expected NPV, they have given the probability as well.
Mm.
So what you need to do is you need to multiply the unit sales with the probability to get the
Cash flow.
what they are. Yeah, no. A study of unit sales produce the following data. This is the unit sales. This is the probability.
Probably.
So out of the total this much, the probability is only 10%. So 8,000 will be your sales.
Yes. Okay.
That's what.
Sales.
These are the sales units. Yeah.
Mm.
So a firm is analyzing a $1 million investment in new equipment to produce a product with 5%, $5, sorry, per unit margin. So this is what we will be multiplying with the sales, the total sales, what we are going to get. So it is going to be 8,500, 9,000.
17,000, 27,000.
Yeah, 9,500. Then here, what we can do, no, sorry. This one also is,
Second one is
sorry,
17,000.
yeah, I'm doing. So it is 17, 9 threes are 27,000,
27. 19.
yeah, 19,000, 10,000,
10,000.
11.
11,000.
This is the case. So the total sales units will be 92,000, right? This is 100%.
Yes. Okay.
Now 92,000 into what is the margin, $5 per unit margin. So how much it will be? 4,60,000, right? This is
60,000.
your, yeah, this is our inflow. Sorry, outflow. Sorry, inflow. We are doing sales, right?
Inflows.
Yeah, this is the sales units. So we are selling 92,000 units at the rate of $5. We are getting the margin. So 4,60,000 is our inflow. Okay. So annual cash inflow is 4,60,000. we want after tax, like this is cash inflow, right? If we remove income taxes, we
Yeah.
will be getting net income, correct?
Yes, sir.
Yeah, see, like what happens, this is the revenue. This is the revenue, correct?
Mm.
From revenue, are we having any kind of other expenses here?
No, sir.
No, only the thing is there is a depreciation which is going to happen, which we are going to take the
Mm.
depreciation tax shield, correct?
Yes, yes, sir.
So whereby now less income tax we are going to remove at the rate of 40%. So how much?
40%.
Yeah,
2,76,000.
this 2,76,000 is our after,
Tax
I think
cash
it is
flow.
net income, right?
Yes, sir.
Now we are going to add the depreciation tax shield to make it cash inflows. So add depreciation tax shield. So to net income, if you add depreciation, it becomes cash flow, right?
Yeah.
1 million divided
1
by
million
5 is how
divided by
much?
5. 1 million divided by 5.
Is how
2
much?
lakh. 2 lakh, sir.
Yeah,
Into 40%.
yeah, into 40% to get the shield, 80,000.
80,000. Yes.
Because 1 million by 5 is annual depreciation is 2 lakhs and annual
Mm.
depreciation to tax rate is tax shield, right?
Yeah, right.
Depreciation tax shield is here. Then we get the like net cash
3 lakh
inflows.
56,000.
Yeah. And then we have to take the factor to find out the present value of this, right? This
Mm.
is for how many years it's going to happen. This cash flow is going to be for 5 years, right? The
5
life is
years.
for 5 years. 5 years. But
Yeah.
with the
5
sales,
years,
what we are
12.
showing, sorry, 5 years. So we will take
Yes, sir. 5.
annuity factor, right?
Yeah, right.
Yeah. So just a second. The equipment will last 5 years. Acha, okay. Okay, okay, okay. But annual unit sales 1, 2, 3, 4, 5, 6 years they took. Can you tell me what is the factor at the rate of 12% for 5 years?
3.605.
Okay, 3.605, right?
Yeah.
Okay, okay. But the cash flows we are taking for 6 years and factor, you have checked it, right?
Yes, sir. 5 years, 12%.
How come then we are taking the sales of 6 years?
But
The
here
line
in question, he has given for 5
five
years
years,
equity.
5 years life,
Mm.
right? That's what. So PVF annuity 3.605. Okay. So what is that you're getting here?
12,83,380.
Right? What is the initial investment?
1 million.
So what's the NPV will get?
Yes.
Okay. You can make a note of it. We'll move forward.
Yes. Done, sir.
Yeah. If an investment project has negative NPV, which one of the following statements about the IRR of this project must be true?
The IRR is greater than the company with
No,
D, sir.
see, first of all, what is the meaning of WSEC? WSEC is something whereby you have different sources of finance. So when you have like equity, debt, and preferred stock combination of finance, to find out
Mm.
the cost of capital, you should be doing the weighted average. I'll be explaining that afterwards. But
Mm.
that gives the WSEC. So this is the discount factor right now. Okay.
Okay.
So if an investment project has negative NPV, which one of the following statements? So IRR is negative. IRR is see, we can't say IRR as a percentage be negative, right?
Mm.
But
High
if
or low weightage.
yeah, but if the project has like negative NPV, so what happens? IRR is something at which your NPV is zero, right?
Yes, sir.
Right?
Yeah.
And
Right.
if my IRR is like 10%, at which I'm getting zero, and if my WACC is 14%, right?
Mm.
So my NPV is negative, right? So at 10% my NPV is zero.
Yes.
So definitely at 14% my NPV will be
Negative.
negative, right?
Yeah.
So
Negative rate.
if the investment has negative NPV, IRR is less than WACC. Is it right?
Yes. Mm.
Next
B.
one. Yeah.
Okay.
Next question. A corporation has not yet decided on its hurdle rate, that is its desired returns, for use in the evaluation of capital budgeting projects. This lack of information will prohibit the corporation from calculating a project's dash. ARR, NPV, IRR. What? See, first of all, hurdle rate is not required for ARR because we are not going to discount anything here, correct?
Mm.
Are
Right.
you going to discount anything for ARR?
No, sir.
You are not going to take the cash flows like even for calculating ARR, you are going to take the accounting income, correct?
Mm. Yes, sir.
So since accounting income is taken, there is no chance of any discounting.
Okay.
And what about IRR? See, like without knowing your cost of capital as well, you can find out your IRR with trial and error method, correct?
Yes, sir.
But corporation, if they do not decide the hurdle rate in evaluating capital budgeting projects, they can calculate NPV. Can they calculate
Yes.
without
NPV
discount? Without discount factor, how will you calculate your NPV?
No, no, sir. No, we
That's
can't.
what. So for this, not required. For this, also not required. For this, we want hurdle rate. So can I say this is the answer?
Yes.
This
No.
can be done with trial and error, taking a lower and higher rate, taking any particular rate and finding out for which we get negative and positive NPVs. For this, we want accounting income. We don't want cash flows.
Mm.
For this, we want.
Okay.
Yeah, next one. Accelerated method is nothing but double declining method, whereby the depreciation what you are calculating, as suppose if the straight line method depreciation is 10,000 for at the rate of 10%. For double
Mm.
declining, you will be using the double of this. You will be removing 2 times of this. That means you'll be removing 20,000. Understood?
Okay.
That's called accelerated method. Example. So the use of accelerated method instead of straight line method of depreciation in computing the NPV of the project has effect of dash.
D.
Yeah, if your depreciation is more, then definitely the tax shield value will be more, right?
Yes.
For example, if
If
I'm taking 30,000, 30% on this, it is 3,000. If I'm taking 30% on this, it is 6,000.
6,000.
Very good. Next. The management of a company will rent office space if the present value of the lease payment is less than this.
Okay.
See, the management of a company will rent, so they will take the property on rent, right?
Yes, sir.
If the present value of lease payment is less than this, so there is difference between lease and rent. Rent is every month you have to pay. Lease you can fix as per the agreement. You can pay that. Okay.
Yeah. Right.
So there people use the term lease rental as well sometimes. So
Okay.
lease agreement and normal rental agreement are somewhat different. So management of a company will rent office if the lease payment is less than this. That means they are happy to take an office space for rent if they if someone is quoting them less than this value. That means they will be comfortable to pay that. Are you understanding?
Yes, sir.
So if someone tells me that I will be like charging you 50,000 as rental for 2 BHK, I'll be saying if 30,000, if my rental is below 30,000, I'll be happy, like that they're saying. I'll be comfortable to pay. That is in my budget. The company uses a discount rate of 10% and all payments are due on December 31st each year. The facilities manager for the company has found the following potential office spaces to rent. There are 3 locations. Location building X, building Y, building Z. Okay.
Mm.
And annual rents are given, rental periods are given. Now, based on the management selection criteria, which lease should the company accept? So, what can we do? So, we can take annuity factors here, right? 10% is the discount rate given, isn't it so?
Yes, sir.
So, we will see like something like we will consider only those buildings whose lease is less than 1.5 million, correct?
Yeah.
So let's take building X 450,000. The 4 years annuity factor, present value annuity factor at the rate of 10% for 4 years is
170.
3.1699. Yeah. And then 650 for 2 years, 1.7355. Then 615,000 for 3 years, 2.4869. Just tell me the values what you're getting. Here you'll get 1426 455. Here you'll get 1128,075. Here you'll get 1529 444, and this is more, right?
Yes.
So
Yeah.
only they can consider what here?
X and Y.
X and Y
Y.
only. Yes.
Okay.
Shall we move forward? Want to copy?
Yes.
Next question.
Basic time value of money
Just give me a
consequence.
second. You carry on, Samrin. I'll just shift to some place because
Oh,
there's no battery. Yeah. Okay, so have you done this?
Yes,
Basic
answer
TVM concepts concern
risk
interest factors, risk, cost of capital. What?
D.
See, basic time value of money concepts concern interest factors,
Interest factor. Yes,
risk,
yes.
but do
Cost
you
of
think
capital.
no? For basic, it is not there. For basic TVM, it is not required. For
Okay,
specific, it is required. Okay.
okay.
Cost of capital is required for specific calculation applications,
For base.
not for basic.
Okay.
Question number 50. So time. The financial analysis department has analyzed a proposed capital investment and calculated the appropriate incremental cash flows as follows. So this is outflow, these are inflows, right?
Mm.
Again, there will be outflow here. So what they are saying, NPV of approximately 25,000 and an IRR of minus 29% were calculated for the project. And the project was submitted to the board of directors for approval. Which one of the following statements is correct? So you should tell me.
And we can.
See, the problem with such kind of questions is this is a question of uneven cash flows, right? What do you mean by uneven cash flows? There is a negative cash flow, then there are positive cash flows, there is again a negative cash flow, correct? So there will be
Mm.
a problem of multiple IRR, correct?
Yes.
So the project has IRR in addition to minus
Addition
29.
mass.
Great.
Mm.
Shall we go forward?
Yes.
Multiple IRRs when you have uneven cash flows.
Okay. Okay, sir.
Okay, yeah.
B.
Company has unlimited capital funds to invest. The decision rule for company to follow in order to maximize shareholders' wealth is to invest in all projects having an. So what can be the answer for this? NPV greater
B.
than 0.
0. Yes.
So if you have a positive NPV, you can invest in the projects, right?
Mm. Yes.
Next question. Company is considering an investment with following after-tax cash flows. Required investment is given, cash flows are given. Okay. Company uses this. Can you find out the NPV? I think this is a very simple question.
Yes, sir. Yes, sir.
You can do this. I'll just I'll just write down the things
Okay.
simultaneously. You can do on your own. Investment is given, cash flows are given.
Discount factor 9%.
Discount factor is like first is 000 at the rate of 9%. When you multiply, it will be the same. Just a second, Samrin.
Okay, sir.
Then the calculation, we multiply this two, we get
I
7.
got 29,012, 2009-12.
Yeah, yeah. So this you are getting right. So if we subtract all, we'll get 2009
Approximately.
negative NPV, right?
Yeah.
Approximate.
Okay.
So summary, like, can we continue this after this?
Okay, sir.
Yeah, because I have some work for an hour.
Okay.
Probably we'll take one more hour. Definitely we'll take one more hour
Okay.
session. That is what
Okay.
sure I'm
Mm.
going to take today at any cost. Because if I take 1 hour session, I'm going to reach till 60, right? And after 60,
Yes.
I'm going to take
Mm.
some more 15 or 20 questions from some other section. So then next weekend we
Oh,
can close this, right? Then we can start long-term
yes.
financial management questions. Okay? Okay, sir.
Yes, sir.
Yeah. So I'll be like messaging you what time, right?
Okay. You will text it.
Yes, yes, yes. Okay, sir. Thank you.
Uh,
Thank you so much. Thank you.
I'll,
Yeah, yeah.
thank you.
Thank you.